Institutional trading operates on a scale requiring constant, high-volume counterparties. Market moves are engineered to pair massive institutional sizes with available retail liquidity. Classical technical analysis instructs retail traders to buy at support and sell at resistance. Institutions recognize these levels as predictable zones where retail participants cluster their risk. This chart illustrates the support trap. Price bounces repeatedly to build confidence before it dips under the line, triggers a red flash of retail stop losses, and aggressively rockets upward. By engineering that dip, large players triggered a cascade of sell orders, generating the high-volume liquidity required for their own massive buy positions. To remain competitive, traders must move beyond traditional patterns and learn to map equal highs, fair value gaps, and breaker blocks. Smart money concepts provide the specific framework used to decode this institutional order flow. Mapping these structural footprints allows a trader to see the hidden mechanics where retail orders are absorbed by institutional size. Identifying institutional volume requires first locating the liquidity needed to fill massive positions. In this Bank Nifty chart near the 54,300 area, these equal highs represent a highly concentrated zone of resting retail stop-loss orders rather than a structural barrier. Institutions drive price into these pools using a sweep. Triggered retail buy stops instantly become market buy orders. This provides the exact liquidity institutions need to execute their own massive sell orders. A sweep leaves a distinct footprint on the chart, a false breakout characterized by long candlestick wicks at structural extremes. Once the institutional position is built, the market targets the opposite liquidity pool as a high-probability take-profit objective. This phase is known as the hunt. We see the result of the hunt here as a violent price drop, descending from the 54,300 level toward the resting liquidity at 52,500. The gravitational pull of resting stop losses provides the primary motive force for price movement in this framework. Aggressive institutional momentum often outpaces all counterparty liquidity, leaving behind a specific structural imbalance. The fair value gap is the core footprint of this aggressive participation. This diagram identifies a fair value gap by marking the high of candle 1 and the low of candle 3. The shaded area between them is the imbalance. This price inefficiency represents a zone where only buyers were offered, indicating a significant lack of opposing liquidity. Trading fair value gaps blindly is dangerous. Many are never filled, despite common retail misconceptions. High-probability setups prioritize gaps formed immediately adjacent to a major demand or supply zone. These act as hidden support levels. Price retraces into the shaded box and instantly reverses upward, front-running the deeper demand zone entirely. Fair value gaps are the primary institutional entry vectors. Waiting for price to return to the textbook origin base often leaves traders on the sidelines. When a historically unbreakable demand or supply zone finally fails, it creates a specific opportunity for a trend reversal trade. This PNB weekly chart shows a massive rally from 70 to 130 originating from this strong demand zone. Invalidation occurs when price breaks it aggressively. Following a violent break, the zone flips its function, transforming into a bearish breaker. This violent break traps retail participants who bought the historical support expecting a standard bounce. When price returns to this level, trapped buyers exit their positions at break-even. This creates a wave of sell pressure, causing the price to reject downward aggressively. Breaker blocks weaponize the desperation of trapped retail traders, turning failed classical support into high-probability institutional resistance. The final institutional manipulation involves a meticulously engineered structural trap. Inducement is a false structural level created intentionally just before a true point of interest. This premature support induces retail traders to buy early, placing their stop losses just below this false floor. Institutions sweep this manufactured liquidity to fuel their actual entry. Identifying the inducement level before entering a trade is critical to avoid becoming the liquidity that fuels the real move. Smart money concepts track the specific locations where institutional volume is mathematically forced to transact. We apply these concepts through a unified, multi-timeframe framework. First, scan the chart to locate resting liquidity pools. Next, identify the fair value gaps left behind immediately after the sweep. Finally, wait for structural invalidation to confirm the trend change. Every execution requires asking the same question: where is the trapped liquidity? Mastering sweeps, imbalances, and rakers allows you to identify engineered traps and trade alongside undeniable institutional structural footprints.